We're excited to welcome Dan Cooperstein, Senior Vice President of Compliance here at Corporate Synergies. Today, Dan is going to discuss the Affordable Care Act and dive into where risk is rising in 2026. If you have a question, you can submit it in the chat, and then if we don't get to it, you can follow up with us via email. Today's recording and slides will also be sent via email within the next day or two. And then for those who are eligible for SHRM or HRCI credits, we will include those in that email. So with that, Dan, feel free to take it away.
All right, great. Well, thank you. Thanks, Brianna. And also, I'd like to just start out by giving a big special thanks to my amazing team of talented compliance consultants over here who do really everything it takes to ensure that our clients at Corporate Synergies and the Foundation Risk Partners family of companies understand all the changing laws and regulations out there, and especially the ACA and its complicated rules. You know, they're out there trying to help all of our clients avoid fines, penalties, lawsuits, and other bad things like that. So, thank you to my amazing team. So today we're going to talk about the Affordable Care Act, Obamacare, the Patient Protection and Affordable Care Act, PPACA, however you want to call it, but probably most simply just the ACA, which is becoming more and more high risk for employers and plan sponsors in 2026 as macroeconomic, regulatory, and other factors have really made it harder and harder to really to meet to meet the ACA's affordability thresholds, and and as IRS and other factors, IRS enforcement of the ACA employer mandate penalties has accelerated this year. So there's just a number of different factors that are kind of coming together to really kind of challenge, challenge employers and kind of make things a little bit more complicated this year. So in this webinar, I'm going to start off by breaking down really the most important ACA developments that are really impacting employers today. And we'll do a brief refresher on the main ACA employer mandate rules. And we'll discuss some of the areas where we see compliance mistakes occurring. And then from there, we're going to talk about some helpful strategies and best practices for how to prepare for what's next. So let's jump in. So in addition to the ACA changes that I've already mentioned, right? Employers are also navigating the growing use of individual coverage HRAs or ICRAs, new rules from the recent tax reform legislation, the OBA, new reporting rules, recent changes causing uncertainty around the ACA preventive care mandates. So adding to all this, we've seen an increase as well in a risk of fiduciary litigation surrounding health and welfare plans that, while really not part of the ACA, definitely adds a layer of scrutiny over plan decisions pertaining to ACA compliance and and penalty avoidance. So as a result of all of this, right, all these multitude of forces, these multiple forces hitting all at once, which you might call a giant risk storm, implementing clear policies and procedures, clear communication with your employees, and an effective compliance strategy, all of those things are much more important now than ever in 2026, and that's really what we're hoping to help you all with today. But before we do that, quick disclaimer, and then a fun game we can play as we go through this. So first of all, we'll be talking about some political changes and other political stuff, and so as you probably know, we don't take any political positions here at Corporate Synergies, and as you know, we're agnostic on the political front. We're really here just to try to help make you a better employer and plan sponsor, so you kind of understand how the political winds shift a little bit, and that's the main goal with that. And then secondly, and I think consistent with our theme today of the giant risk storm, I've inserted some images from famous movies involving storms into the presentation. So if you can correctly guess what movie each picture's from, you can shoot an email to our marketing folks. They're going to give you the email at the end, and the winner who gets all the storm movie pictures right first will be getting a special prize from the compliance team. All right, so let's go ahead and get started. Okay, so the risk storm, right? Why is this a risk storm? Well, at a high level here, there's four major drivers of what I would call the Great 2026 ACA risk storm, right? There's market disruption that's coming from primarily from from ACA premium tax credit. There were these enhanced COVID era ACA premium tax credits that expired at the end of 2025. We're going to talk about that. There's an increase in the use of ICRAs, and there's more aggressive IRS enforcement, and there's new reporting and regulatory changes. And then later, on top of all of that, we've got litigation and preventive care uncertainty. So a lot going on, and let's try to kind of that's kind of the pieces really driving the storm. And So we're going to kind of go through each of these now, I think, in a little bit more detail. So this is really the big driver here, right? This is really the kind of like the story of 2026 when it comes to what's changing with in the health insurance marketplace out there, right? And it's this impact of what's often referred to as the 2026 subsidy cliff. What happened basically was, right, there was a historic enrollment collapse. Between 2025 and 2026, we had over 22 million enrolled in the ACA exchanges or marketplace, the individual market set up by the state and federal ACA exchanges. And that is projected to go down to 17.5 million and potentially as far as low as 16.5 million by the end of 2026. So it's over 5 million people are expected to drop off the ACA exchanges in 2026. And this is really kind of much bigger than I think people, maybe were or expecting. Although KFF actually, the Kaiser Family Foundation, which you see a lot of the data is coming from them, actually even predicted a bigger drop off. But what we kind of saw was there was, a lot of folks, a lot of the individuals were dropping down from richer exchange plans on the exchanges down to bronze plans on the exchanges that had lower premiums but also higher deductibles. And so that kind of changed a little bit of the predictions of what we thought would happen in 2026. But if you look at these stats, these are some pretty big numbers, right? The average out-of-pocket premium has jumped 58%, right? Anytime you see a 58% premium increase, right, that's huge, right? And also the ACA deductibles surged by 37%, or approximately $1,000. So that's the steepest single year increase in the history of the exchanges. And right, and this is really, like I said before, this was caused by the sunset that happened as a part of part of the OBA, right? It sunset these enhanced COVID era premium tax credits that were initially released under the ARPA, the American Rescue Plan Act back during the pandemic, and they were extended under the Inflation Reduction Act, the IRA, and they went all the way through December 31 of 2025. And right, so now that you're not going to get, so basically what happened was, right, if you made over 400% of the federal poverty level, you just didn't get as much of a subsidy from the government. So you didn't really get anything. And so what happened was, right, those folks dropped off at a much higher rate from the exchanges, and the folks who were still in the exchanges, they went to lower cost plans. And obviously that the rising cost problem, right, had a kind of a big effect on a number of different folks in the individual market, but also affected the employer market, right? So it was one of those things where, it didn't have as big of an impact on the employer market. If we're looking at this from the standpoint of employers, right, there was a still a pretty sizable increase between 2024 and 2025. We saw average, per employee health benefit costs rise approximately 6% in 2025. And then we're looking at, they're projected now to increase to 6.7% between 2025 and 2026. So not like the 58% premium growth we saw in the exchanges, but look, there is still a cost impact here. And right at the end of the day, right, what does this really mean for employers? Well, more employees are now really shifting expectations to employer coverage, or at least they would prefer to be on an employer-sponsored plan. But and this is really the big but, right, is that affordability pressure is also increasing for employers, right? And while it may not be out there in those big headline numbers that we're seeing on the exchanges. Um, the Anecdotally, right, from speaking to employers across the country and seeing what's happening, right, and also, there's a lot of costs that are going up, right? We'll talk about why, what's really going on in a little bit more detail, but really the costs are not small, right, on the employer side either, particularly for employers who are we're hearing about getting hit with high claims costs, and who may be self-insuring out there, right? Those costs are going up, and then as a kind of you know, what we're also seeing too is this big transition to ICRAs. Now, this, of course, right? These numbers you see on this slide are from the last year, from the 2024 to 2025. Uh, the growth in employers adopting ICRAs, but we expect this to be much higher. We should be getting the numbers this type of the same report that'll be coming out probably by the end of this month. And we're probably going to see a much bigger percentage growth number between 2025 and 2026 when we get that data. But even looking at it from 2024 to 2025, you can see that trend that more and more employers are adopting ICRAs. And certainly by, anecdotally, really coming from what we hear from clients, right? This is a response to these extreme cost increases that are going forward on the claim side. So especially if you've got a self-insured plan or a hybrid level funded type self-insured plan, right? You're seeing these astronomical cost increases from claims, and a lot of this, may be driven by the demand for higher cost GLP-1s. It could be stemming from, look, AI is getting smarter, helping pharma companies get more innovative, and they're developing new drugs at higher costs at a faster speed than they were able to before. Um, but there's really a lot of different reasons, right? We don't really know exactly what's causing it. What are the underlying causes for these things? We just don't know. I mean, it's really uncertain, and I think a lot of the I follow a lot of the healthcare policy experts and economists on X, which one of my associates here refers to as the artist formerly known as Twitter. And these experts have all these different theories and models explaining the why here, but you know it's a difficult answer. It's a difficult question to try to answer accurately. I mean, some of the main culprits that they point to for these cost increases are hospital consolidation driven by private equity, more innovative drugs coming onto the market, including GLP-1s, driving up costs from the formulary side of the house. Cost increases come from other sources like insurance companies, and anyone can probably put a thesis together as to what's really driving it. And even while historically, right, healthcare inflation has outpaced regular CPI or regular inflation, there's really no understanding as to what's really making this big shift up in costs. But it's happening. So, and then one final note on ICRAs, right? ICRA growth on this slide, right? Just to kind of understand more about that question of why ICRAs, right? Why are employers going to ICRAs? Well, ICRAs are growing fast, especially among the mid-sized or middle market employers from a few hundred to a few thousand employees. And I think the appeal is really the flexibility and the cost control, right? Because the ICRA works like a defined contribution plan that is ACA compliant, meaning you can contribute a set defined amount of money to either a group of your employees, like a classification of your employees or all of your employees, to buy coverage on the ACA exchanges. And then you're no longer subject to those unusual claims hits, right? That can derail, from your own group health plan, right? That can derail your operational budget for the year and really kind of mess things up. And so you're essentially shifting that risk right to the exchanges, and you don't have to worry about something called an unlawful employer payment plan under the Affordable Care Act, which is where you can face very steep ACA penalties for reimbursing an individual's medical coverage without a formal plan or program for similarly situated employees. And also, those are the things that are really great about ICRAs, but that also comes with a lot of added complexity. And so if you don't really know what you're doing, you don't know, for example, how calculating the ICRA affordability is different, or some of the other nuances, and we'll discuss some of the big ones that were some of the common issues we're seeing out there in just a little bit, right? It can get really tricky. It can get tricky fast. So I think the key message here is that while ICRAs can be safer in some ways, and they can certainly insulate you from some of those big, large claim risks that are out there, they also do add quite a lot of complexity. So just something to be aware of. So, um, I think a lot of that also just comes from just the fact that the affordability analysis and some of the other ACA compliance requirements are they're more local, dynamic. They're a little bit harder to manage, and we're going to talk about that in a little bit. Okay, so and this is just some additional information, kind of from that report that I was referring to earlier, that came out, um, in last June, that kind of talked about the increases in growth between 2024 and 2025, and and these are some pretty big numbers, right? So we already were seeing big growth, but I expect those numbers to be much bigger between 2025 and 2026. I'm just saying that from I'm just speaking again anecdotally here from just conversations I've had with clients and seeing this trend, but more and more employers that we work with are switching to ICRAs, and and that's kind of a big trend that we're seeing out there. Okay, so so let's talk about this other thing I mentioned kind of at the very beginning of our talk today, which is that, right, IRS enforcement has picked up. So we're seeing something I like to call it the employer mandate strikes back effect. But basically, what happened was the ACA employer mandate penalties that you can get, or employer shared responsibility penalties, sometimes referred to as play or pay or pay or play. Right, they kind of took a little bit of a break in 2025, and I think part of that was because uh, there was the whole Doge initiative, right? We saw a lot of the reshuffling. We saw folks get ripped. They got a voluntary retirement package. Things are moving around, and there just seemed to be kind of a little bit of a break in IRS enforcement in 2025. Well, it's very clear to us that the break is over. We're seeing a lot more folks that are getting these recently, and so it's really important to kind of be aware of that. And again, this is anecdotal. Again, I think unfortunately I don't have real specific stats as to how much it's increased in Q1 of 2026, but we're seeing it, and it's when it comes back, it strikes pretty hard, and it's something to be aware of, and it's a major risk that's part of this increasing risk storm that we're seeing in 2026. I think, and on top of all of this, right, I kind of also mentioned before, right, that there's been a number of new rules, regulations, changes to how the ACA pay or play rules are being enforced, and with that, right. So one of the things that happened was really something that happened at the end of 2024, which is that we saw these two new laws, the PBRA and the ERIA, update the process for ACA compliance. You basically could change to an upon request furnishing methodology, where you no longer have to send out paper copies of the Form 1095-C to all employees. You could have a notice of availability that's available to folks that tells them that they can request it, and they'll get a copy, and then you don't have to do the furnishing. Also, these laws change the time period to respond to an IRS penalty letter, which is called the IRS Letter 226J, from 30 days to 90 days, which was a much welcomed relief for employers, because oftentimes, especially at larger organizations, if they received a penalty, the 226J letter, it takes a little bit of time, right, for that letter to get into the right hands, and your 30 days might be up, even before the right person gets a copy of it, right? So you have the 90 days now. And but right, you still may need additional time. So what I always say is, it doesn't hurt if you have a good reason for why you couldn't respond in the 90 days, to still request an additional extension, and IRS typically has been very flexible with that, and has granted that. And also, one additional thing is that it put a 6-year statute of limitations on the collection of these employer mandate or ESRP assessments in the 226J. So they can't go back more than 6 years to collect those penalties, which I think is another win for employers. So I think, while these things, right, they sound like they're right, all of these things I think are really important, right? They give you, they're positives for employers, and they give you more flexibility. I think you still have to really exercise caution here, right? You want to make sure that you're documenting everything. If you're using automation and tracking tools, or even AI in this process, right? Make sure you have a real human somewhere in the loop to make sure that things are being checked and reviewed properly. And while this definitely can reduce your furnishing obligation to right to send these forms 1095C out to employees when you're doing the reporting. um, you still may have to comply with the state individual mandate reporting rules. We'll talk about that in just a little bit, where they do require you to furnish and you right those same forms 1095C, but to employees based on where they reside, as opposed to where they work. So just something to be aware of. Now, most in the, realistically, most payroll reporting, reporting vendors that do ACA information reporting will kind of be on top of this and will know how to do this, but it is just something to check to make sure that it's being done correctly. Um, in addition, we saw a change in the inflation adjusted affordability percent that was very, very high, right? It went really one of the biggest jumps ever. If not the biggest, I think it might actually be the biggest jump ever. It went from 9.02% in 2025 to 9.96%. And really, that is a win for employers because they can arguably, it marks the highest affordability rate since the years before, really that before 2023. So if you go back to a time period between 2018 and 2022, it was pretty close to 9.96. I don't know if it ever got, I don't think it ever went over 9.96. It got close to that. So it's almost like we're going back to that time period. And why it's such a great thing, I think why it gives employers more flexibility, right, is that you have more room to shift premium costs onto workers if you want to, if you want to do that, right? So you can legally now ask employees to pay for a much larger share of their health plan before triggering these IRS pay or play penalties. We'll talk a little bit about how that works, but if you use the federal poverty line, just to give kind of an example of how this kind of plays out, is like if you use the federal poverty line safe harbor to simplify compliance tracking for employees working in the mainland U.S., right? Your maximum allowable employee cost for the single only tier of your health plan coverage is jumps from about $113 to almost $130, right? So you're looking at almost $20 and of additional money you could charge on the employee share of the premium. And for a 200 employee size company, assuming just you can charge $20 more, and utilizing that full max cap, right? That maximum amount of premium, that comes out to about $48,000 in annual premium costs away from the corporate budget and put onto the employees. Now, granted, like that's not going to work for everybody, right? There's always that talent and retention type risk, right? You have to there's always that delicate balancing act. If you're shifting too much of the cost burden on employees in a competitive labor market, right, you could hurt your retention, your recruiting efforts. So it's definitely something that you want to really consider closely before you actually do something like that. But that change gives you some additional flexibility uh, in that regard. Okay, so let's talk about a little bit about the penalties. So even though they gave you the nice to have kind of additional um, you know room to on affordability, it's still you still have to pay more in penalties, right? So if you don't get any of the stuff right, we're going to talk a little bit about this. We're going to do that refresher of the ACA rules, but the penalties are going up, right? And that's kind of track two, and those are inflation adjusted penalty amounts for both the large penalty under Code Section 4980HA and the small penalty, which is they're going up, and that's going to probably continue to go up with inflation, and so it's something that we're obviously always watching and on top of. And this is just sort of a helpful chart to kind of show you how these state individual mandate. It's really more for your own reference how the state individual mandate rules work. But as you can see, right, there are um, obligations to furnish to the employees that are residing in these states. And that's something to remember, right? Even if let's say all of your employees work in one state, if they all reside in one of these states, like let's say your office is in New York, but you have a lot of employees residing in New Jersey, you just need to really make sure you're on top of that, or with your ACA reporting vendor. In most cases, the ACA reporting vendors are really from what I've seen, are really on top of this, and so it's not a major problem. It's just something to kind of be aware of. Okay. Um, So let's talk a little bit about the OBA. Now, we just not too long ago, I think it was less than a year ago, we did a webinar on this. You probably get it. You can see my webinar on it. I did with Ben Conley at Seyfarth Shaw. The two of us kind of went through and talked a lot more about how the OBA, the big tax reform law from last year, July 4th of last year, how it really impacted the ACA rules. For example, it expanded the HSA access to bronze ACA exchange plans, as well as allowed you to have them with catastrophic plans and direct primary care plans. So we talked more about that in that webinar. But there were a lot of real big cost impacts from this as well, right? So they made exchange premium tax. So the OBA made the premium tax credit verification rules and eligibility requirements much harder, much more strict. Made it harder for for a number of different folks to get the coverage, and so a lot of that stuff happened that really kind of feeds into this idea of the risk storm, right? And why things are moving around and getting more complicated. And the KFF even put this projection out, which showed that 16 million more people would be uninsured from the One Big Beautiful Bill Act, and so by 2034, because of some of these changes. So a lot of things to kind of note that are changing with the ACA marketplace out there, and that could put uh, additional pressures on you if you're offering an ICRA from a cost standpoint, but also just right, it's going to put more demand of these folks to try to get onto the employer plan, which could add costs as well. So just kind of it's important to kind of be aware of that. Okay. Now, this is one of those areas, the ACA preventive services developments, that I think is, really kind of been in the news more. So this is probably one of those things that you may have already been aware of. Um, but we are going to be doing another webinar on this topic soon. So I'm going to probably get more detail on some of these topics at a later point in time. But let's just kind of give a kind of quick refresher on what are the ACA preventative services rules to begin with, right? Well, the ACA requires that non-grandfathered health plans and issuers offer coverage that prohibits imposing cost sharing on specified preventive healthcare items and services, like just general preventive care, your annual physical, um, vaccines and immunizations, and preventive care for children and women. The most famous probably being the contraceptive coverage mandate. Um, and so all of those things are have to be offered by you know comprehensive group health plan coverage at no cost to the employee. But they're right now under this current Department of Health and Human Services and under the leadership of Robert F. Kennedy Jr., they've been really challenged. And we saw actually some challenges even happening kind of before, uh, you know, um, really with this case of Kennedy versus Braidwood Management that went all the way up to the Supreme Court and was decided in June of last year. Um, and basically, this was a case where a number of different individuals and businesses challenged the legal validity of ACA preventive services recommendations from the U.S. Preventative Services Task Force that was set up under the ACA to really create these recommendations as to what will constitute ACA preventive services. Right? They said it was unconstitutional, and also that these preventive services requirements violated the Religious Freedom Restoration Act, and this got appealed all the way to the Supreme Court, which ultimately upheld the validity of these U.S. PSTF recommendations under the ACA Preventive Services mandate. So that was kind of like an earlier challenge, and then more recently, in early 2026, HHS, under the leadership of RFK Jr., initiated really what is an administrative overhaul of the panels that are governing ACA preventive care lists and uh, AKIP vaccine schedules, right? So really, they really wanted to kind of change the rules around about what kind of vaccines are recommended as ACA preventive services, and then initially um, the federal courts temporarily blocked these changes back in March 2026, and this litigation is still, ongoing. But essentially, for now, there isn't any change that needs to be made. So that's, I think, the good news, the big takeaway, really, for the impact for all of the folks out there who are uh, benefits managers, HR managers out there, is that you don't need to worry about it yet, but it is something we're watching and we're staying on top of, and it may change how the out of pocket costs, right, on vaccines and other preventive services that your plan currently offers. And then I think this last kind of piece to this, which I think is not really even not really even the ACA, right? It's something that is happening really under ERISA, is that we're seeing a big increase in ERISA fiduciary litigation that's happening. And that's, while it's not part of the ACA, it's adding a lot of scrutiny to the way that your organization, your plan administrators, your plan fiduciaries are handling the ACA administration. And so, uh, some of these complaints and cases recently have looked at, like, the PBM relationships, the prescription drug programs, voluntary benefits, and basically they're alleging that there's been mismanagement, that the vendor costs are too high, that the plan didn't do enough to monitor the fees and the commissions here, and just didn't really do a good job of selecting service providers. And I think, if you'll remember, obviously this is not the main focus of today's talk, but right, the CAA of 2021, Consolidated Appropriations Act of 2021, required that your plan designate a responsible plan fiduciary for ensuring that all of the service provider compensation is reasonable. You need to, be doing something along those lines to kind of having more oversight over plan vendors. And of course, there's a lot of plan vendors that help with ACA administration. So I think it's important to kind of keep those things in mind as you kind of go through, and plan ahead accordingly, right? Um, Now, I think this part, and this is one of my favorite movies of all time, by the way. Um, but anyway, I think it's really important to kind of look. I think just get a basic refresher here, just so we're kind of all on the same page. And I think I probably assumed a lot of knowledge in the beginning there, but I think it's good to kind of get a sense as to um, how this all works, right? The big risk are these employer mandate penalties under the employer shared responsibility rules of the ACA, which can many times be in the hundreds of thousands, if not millions of dollars, and can really, put businesses out of business, right? I mean, these are major risks that are affecting employers. So I think it's important to just do little quick refresher here about what these rules say. Um, and right, there's two kind of main penalties here, and the first penalty goes into effect if you just don't offer coverage that provides a very minimum level of coverage called minimum essential coverage. And so that first part of the rule, which applies to the large penalty out there, or sometimes referred to as the A penalty, or the sledgehammer penalty, is that you have to offer this MEC, minimum essential coverage, a very basic level of coverage, to at least 95% of your full-time employees and their dependent children. And that if you fail to do that, right, then that's when you face this very large potential penalty of that is multiplied by every full-time employee in the organization minus the first 30. So that's the large penalty. Then on top of that, you've got, so even if you do offer MEC coverage, to avoid the small penalty, you have to make sure that that coverage also provides what's called minimum value, which is an actuarial standard, and basically that the payments into the plan pay for a certain defined actuarial level of benefits, and that piece is actually in the summary of benefits and coverage that you get from the carriers, and it explains if the coverage meets the MEC and minimum value standards in there. And also, the coverage has to be affordable, which is a big part of what we're talking about today. And affordability is really a big part of that. So if the coverage is MEC, minimum value, and affordable, then the good news is that, well, the individual becomes ineligible, right? The employee who that you're offering that coverage to that has MEC, MV, and affordability, that employee that you offer that to becomes ineligible for a premium tax credit through the ACA exchanges. And that's good news for the employer because then no penalty can be assessed on the employer. And so that's the other kind of missing piece of this that I probably should have said about a slide or two ago here, right? Is that these penalties are catalyzed by employees going on the exchange. So in the case of the large penalty, the A penalty or sledgehammer penalty, right? All you need is one employee has to go out onto the exchanges and qualify for and receive a premium tax credit. And if that happens, that catalyzes the large penalty. And then with regard to the small penalty, it's a per employee situation, right? So the penalty only applies per employee for each month for which that employee qualified for and received a premium tax credit on the exchange. So that's why it's so important to be, kind of cognizant of what's happening on the exchanges, and in many ways that that big enrollment drop off that we saw in that earlier slide, right? The 5 million folks who are dropping off the ACA exchanges in some ways kind of helps with your ACA pay or play risk, right? Because there's a lower likelihood that when you have less people qualifying for coverage on the exchanges, then there's less people who could qualify for a premium tax credit on those exchanges, and then that lowers your likelihood that it'll catalyze these pay or play or employer mandate penalties. So that's a big part of this, right? And what about affordability, right? So affordability is kind of the big rule here, and when it comes to right when it comes to affordability, right, there's the way that the statute was written was that it meant the employee's cost of coverage could not exceed 9.5% of their annual household income. But the problem was that there was really no way for employers to figure out what their employees' household income was. So the IRS created these rules. There are three safe harbor tests that you can use to determine if the coverage will meet the affordability requirements. And it's and what you do is you look at the employee's share, the employee's portion of the cost of the lowest cost self-only tier of coverage being offered by the employer, and you try to determine if it meets any one of three available safe harbors. The first one here on the slide is the W-2 wages safe harbor, which says it cannot exceed 9.5% of the employee's W-2 income, as reported in box 1 of their Form W-2. That's really the most common one because you can kind of figure out like really quickly how much your employees get paid, and if it's more or less than the 9.5%. Actually, it's an index number, so now it's 9.96%, but it changes with inflation. And then, of course, there's the rate of pay test, which is where you look at the cost of that coverage on that single only tier cannot exceed 9.5% of the lowest hourly rate paid by the employer to that employee multiplied by 130 hours per month. And then you've got the federal poverty line test, which is generally the cost of that coverage can't exceed 9.5% of the federal poverty line, and there's a slight difference there between the mainland federal poverty line and Alaska and Hawaii. But that's the easiest one to use because you can kind of figure out, you could draw a line in the sand and say the cost of coverage can't be more than X. So in many ways, that's probably the easiest one to administer. Now, this is where I was saying earlier that it can get really complicated when it comes to the ICRAs, right? Because when it comes to these, the individual coverage HRAs, affordability is not based on an employer's, internal plan, but on the cost of the lowest cost silver plan, or LCSP, just to add some more fun acronyms today. That cost that's on the ACA exchange, right, for a lowest cost silver plan on the ACA exchange becomes the sort of the base. But then you have to, in order to test the affordability, you have to take the cost of that LCSP and in the employee's specific zip code. You have to subtract out the employer's ICRA contribution that it makes, right? And then that remaining amount cannot exceed the 9.96% of the employee's household income or one of the safe harbors. And so that's why it's a little bit more complicated, right? Because now all of a sudden it's this individualized inquiry, right? It's an individualized analysis, and it changes depending on the employee's age and geographic location by zip code. And so, right, ICRA affordability has to be calculated on an employee by employee basis. And well, it makes it much harder to just figure out, well, what's that, company wide flat rate that applies to everybody. Okay. So on top of this, this is kind of just shows a little bit about how the big penalty and the small penalty kick in, right? And just it's really more for your own reference. And this is just kind of a little bit of an overview of the reporting requirement, right? So once you've done this, right, once you've set up a system to track hours and determine who's full time for which the folks for which you have to offer the coverage to, um, and you've figured out kind of all what how this all works, right? Then you've got to report on it to the IRS, and there's two main types of reporting. There's coverage provider reporting, sometimes referred to as MEC reporting under code Internal Revenue Code section 6055, and that's done by the insurers and self-insured health plan sponsors. And it's a little bit requires a little bit more detail because you have to report on individuals who are enrolled on the plan in Part 3 of the Form 1095C. So there's some additional requirements there. And then you've got the pay or play reporting or applicable large employer ALE reporting under Code Section 6056, which is really just for large employers, regardless of fully insured or self-insured. Everybody has to do that part, which covers Part 1 and 2, but not Part 3 on the Form 1095C. So and like we said before, right, you also, when you're doing this, you want to make sure that you're taking into account, the state reporting requirements, which in most cases you just use the 1095C, or the reporting vendor will pretty much handle that for you in most cases. Okay. So that's our little quick summary there of kind of what, quick refresher. So how does this impact employers, right? What are the takeaways here? What are common mistakes that we're seeing that are kind of coming out of this perfect storm of 2026? Well, I think the obvious takeaway is, look, costs are going up, right? Even before the Strait of Hormuz was blocked and all the costs went up, and for everybody in the regular inflation world, health insurance costs were going up, right? And I think as risks of costs and IRS enforcement are increasing, and there's all these changing rules and regulations added to that, and penalties are increasing, right? You just have to really make sure you're adjusting accordingly. We're going to talk a little bit about kind of things to do at the end here, but these are kind of the big issues that we see employers having out there, and we're going to go into a little more detail about some of the common mistakes. But the other thing is just that affordability is a moving target, right? It's not just changing because of all these macroeconomic factors we talked about, but because, right, affordability percentage can jump big time year over year or drop year over year big time. And it's becoming harder, I think, for employers to kind of rely on maybe the old contribution structure that worked 2 or 3 years ago. So you just have to constantly be adjusting from year to year and planning ahead. And of course, the ICRA risk factors, right? We talked about how affordability is more complicated for those who are offering ICRAs. And sometimes it's just for a class of workers, or just for you're offering the ICRA to the whole population. But in both cases, right, we're seeing situations where many employers that thought that this was going to be simple on the surface, they found out later that it wasn't so simple, right? Oh, wait a minute, you're saying I've got to do this, employee by employee, individualized, inquiry, and I've got to figure all this out on my own. I mean, that's a lot, right? Unfortunately, the vendors can help you. Like we've worked with, I know I've done a webinar in the past with Zorro, and I think they're terrific. They have a really great platform where it's very easy to see, to model out different scenarios on their platform. But not all of the vendors out there are created equal. So I think it's just important to, that's something we'll talk about in just a little bit, but I think you just really have to make sure that the vendor can do that job and can ensure that affordability is being handled correctly. And then finally, I think, like I said earlier, right, the employer mandate strikes back effect, right? So more employers are getting the 226J letters. So far in Q1 of 2026, we've seen a big increase there, and the lull is over, right? And even with having more time than you used to, right, it can still seem daunting. It can still seem like you don't have enough time with that 90 days. So, like I said before, request the extension if you have to, and that's an important piece of that. So let's drill down into some more specific examples of kind of some of the things that we're still seeing, where some of the compliance issues and risks that we're seeing out there. And this, I'm not going to go through every single one of these, but this is really more for your own reference. Um, but I think one of the big things really comes down to how you're classifying, right? Misclassification of variable hour and gig workers. So the ACA actually requires that if you want to kind of take advantage of the flexibility of having what are called variable hour workers, and those are defined as employees for whom it cannot be determined at the time of hire as to whether they will be working more or less than 30 hours on average per week or 130 hours on average per month. Um, that you need to disclose that from the very beginning, right? You need to put it in writing and communicate to them that they are being classified as variable hour. And very few employers are really doing that and notifying them of that variable hour status. But it also can be challenging, right, for gig workers, right? How do you, how does this all work out? We're seeing a lot of misunderstandings. I think one of my least favorite phrases that I hear out there is, "Oh, we've got independent contractor employees," right, which is an oxymoron and something you would never want to say to a government official because it's an immediate red flag that you're doing worker misclassification because you really can't be treating independent contractors in the same way as employees. Right? They can't be entitled to employee benefits. They can't. They have to have their own tools they bring to the job. Their own. In some places where they really enforce this very strictly, like in New York and New Jersey, the government agent wants to see that they have their own car, their own EIN number, their own logo on their truck. Right? I mean, it's really one of those things where you see very broad variance around the country as to how that's being done, but it can really mess up your processes and policies for tracking your employees. Um, then I think just the affordability safe harbor calculations are not being updated closely enough, right? So, right, as we just discussed, the threshold percentages are changing each year. We just saw a big year over year change, and right, a lot of employers are just doing what they did 3 years ago or 6 years ago when but they're not really adjusting it year over year, and so they could fail on affordability. And I think another big one is this control group aggregation errors, right? We see oftentimes folks who may look small and even be enrolled in a small group market plan, they're part of a control group that um, has a lot more than the 50 full-time employees, in full-time equivalents to trigger that applicable large employer status, which makes you subject to these rules. So it's one of those things where you just have to really be on top of that control group analysis. Make sure you've discussed that with your corporate attorney or tax advisor to make sure the control group analysis is tight and that your ACA compliance strategy fits within that control groups that control group thing. And it is something also you have to disclose on the Form 1094C that you're filing with the IRS. All the other entities that are in your control group. And I think we're still seeing issues with, especially with the larger organizations, not getting that 226J to the right person in time, and so that they have to ask for an extension, or they're just late with responding, and that can trigger, right. If you don't respond to the 226J, then you'll get a letter 227 from the IRS with additional, problems, right? And then they can even go from there to the CP notices, which is where their collection procedures kick in, and they can start to put liens on things, right? You never want to get to that standpoint. So do not be late for responding to the 226J. I think the other thing that I think probably a bigger issue in the early days of the ACA response than what we're seeing now, but still we're still seeing these problems is that, right, there's issues with the vendors. There's technology issues. Sometimes they leave a line blank on the 1095C or on the 1094C. They'll just say no, we didn't offer MEC coverage to 95% of our full-time employees when the employer clearly did. And that's, I think, one of the most frustrating things, because you'll get this letter for hundreds of thousands, if not millions of dollars, because of just a quick little oversight, a check the box mistake by the vendor, right? And I think really, like, that's also kind of related to just seeing the coding errors. And I think with ICRA affordability, not going through getting the geography wrong, or not really looking closely at that very specific analysis that you need to do. Okay, so what are some best practices here? I think this is really what we call our belts and suspenders approach to our best practices to really ensure their clients are not getting penalties, and all of the same things you would do to ensure you don't get a lawsuit under ERISA for fiduciary liability problems. They can all, for the most part, really help you with your ACA compliance, right? Because if you've set up a designated fiduciary to oversee plan service providers and service provider compensation, right? Well, that should help you to make sure you're doing the right thing when it comes to ACA administration and avoiding ACA penalties. So even though this is a slide that we usually put in an ERISA type of presentation, I think all of these things apply. And I think kind of going back to those scenarios I mentioned earlier, I think I just have some helpful kind of advice here for for your plan administrator and folks who are handling ACA compliance. Um, but when it comes to the cost and risks going up, right, you really need to make sure you're implementing the right systems and processes and documenting what you're doing to protect yourself from lawsuits and audits and investigations. But I think that one of the big takeaways here that we're kind of missing, now that we've entered the age of the AI agentic workforce, right, and we have all these amazing tools. You still need a human layer, right? You still need a human in that loop, in that process, to make sure that it's being done correctly. And I also think setting up a fiduciary committee can help to review vendor compensation, to review that the vendors are doing what they said that they would do, and for the right amount of money, and that can really kind of help you find mistakes that are in that loop, right? And I think also affordability is a like you said, it's a moving target. How do you deal with that? Well, maybe just go earlier in time, right? Go plan it out for earlier in advance in the year than what you normally would do, especially if you have an ICRA, right? If you're doing this ICRA individualized affordability analysis, then give yourself the extra time to get it right. I think that's kind of one of the big takeaways there. And then, like we talked about earlier, right, the ICRAs kind of may look simple on the surface, and they certainly add a lot of flexibility and compliance ease, and it's really cool that you can do this, and you don't have to violate the employer payment plan rules of the ACA. They're not as easy as they look, and you really need to make sure that you're working with a trusted and experienced ICRA vendor. And I think if you don't have one, I think talk to your benefits consultant, your attorney, or other trusted benefits advisor, and they can definitely point you in the right direction as to an ICRA vendor that can really help you. And then I think this one has to do with what I called, again, the employer mandate strikes back phenomenon, right? If you are getting the 226J letter and you thought you're doing everything right, well, again, another reason for why you need to remember that to plan in advance, right? And I think there really isn't a one size fits all solution here. And so, you really need to take that time to consider, what are the tools I'm using, right, to track hours and to track ACA compliance? What are the policies and processes I have in place and on paper, and then I'm putting in the plan document, and then I'm explaining, they're how we're supposed to do it, and then third, right, how do our operations, how is our plan being administered and operated in a way that really conforms with those things, right? You have to think about all those three things together, and while you do that, you have to kind of just remember that data integrity, right? You have to really treat data like a compliance asset, because data integrity is king, right? It's garbage in, garbage out, right? Is a problem that we see a lot in this world, right? Because you don't have a real human in that loop that's, making sure that, you can't, this is not something you can just say, okay, we have Mythos Fable 5 now on Claude. And so we could just build something out in 2 minutes that's going to solve the problem right away. You need to really, really make sure you're getting this right, and that there's a human somewhere in that loop. And then I think, also just really make sure you've evaluated the ICRA opportunity closely for your organization, right? Draft out that plan and that cost benefit analysis before you make the jump to the ICRA, so you really know that it's going to work for you and your organization. And I think kind of the big bottom line for today really is like ACA compliance and penalty avoidance is really now a strategic risk management issue. It has to be a detailed and specific process built in a way that's really narrowly tailored to fit your organization, right? It has to be customized for your industry, your geography, and the needs of your employees and your customers, right? It's not just a simple reporting requirement or a checklist, right? It's a lot more than that. So thank you. Thanks for your time today.
Thanks, Dan. Thank you to everyone who joined us. We hope you found the session valuable. Feel free to follow up with the email on the screen, info@corpsin.com, if you have any questions, or you can email Dan directly. We have a few upcoming webinars as well. You can check them out on our events page. And then also, once again, the recording and slides will be sent in an email with the credits for those who are eligible. I'm going to put a survey in the chat if you could fill that out. It will also be in the email if you don't have time to stick around and fill that out right now. It'll only take a few minutes. Thank you guys, and hope you have a great rest of your day.